The Cyprus bailout may be off the headlines, but investors should not erase it from their memories, says my next guest, Anjun Zhou from Mellon Capital. Welcome, Anjun.
Thank you.
All right, so what's the big takeaway from the Cyprus bailout as it pertains to U.S. investors?
A big takeaway for us is that Cyprus recapitalization serves as a fresh reminder of the structural issues of the Eurozone. And to the extent that Cyprus is small, it's not really to our primary concern. However, there might be a risk of the contagion of bank run toward some of the peripheral countries of the Eurozone, which we are watching very, very closely. So as long as that's being prevented, that would be serving as some safeguard.
So if Cyprus is too small to knock U.S. stocks off track, what would?
Italy and Spain. Those are still the countries that we watch very carefully. As the Cyprus recapitalization issue resurfaced, we saw that the CDS for the sovereign bond of Italy and Spain have jumped up, right? So that's something that serves as a fresh memory that investors are watching, they are nervous, and they are really making sure that the central bank can prevent that from happening.
Would you invest in European stocks right now?
We like core European stocks, such as Germany and France. The valuation remains very attractive, and at the same time, the fundamental picture is more solid than the peripherals.
Okay, and what about the BRIC countries? Because the BRICS have not fared as well over the past 3 months as U.S. stocks or even Europe.
We look at the emerging market countries as a complex, and within emerging markets, we like China, we like Brazil, particularly for their growth potential. And also in terms of cross-border trade linkages, they appear attractive than other emerging market countries.
Now, Japanese stocks have done very well as the yen has weakened. The Japanese stocks have really kept up with the S&P 500. Will this continue?
We don't have a strong view in favor of the continued rally of the Japanese stocks. In particular, the valuation doesn't look particularly attractive, although the most recent earnings trend in terms of earnings revision have been revised upwards. So that's something to watch. Overall, we're neutral to Japan.
And finally, gold was down 5% in the first quarter. In one of your November letters to shareholders, you said that inflation could spook people when people least expect it. So what's your feeling about gold now, and how can people protect themselves if inflation does pop up out of nowhere? Because right now people aren't expecting it.
That's absolutely right. So we look at unexpected inflation in particular, which by definition is unexpected. And part of the reason behind it is the relentless amount of central bank printing. With a lot of money and liquidity in the system, once the recovery gains the strong footing, we would see that inflation potentially popped up beyond people's expectation. In that case, investors should protect themselves by investing in commodities, including gold, and commodity-related global equities.
Thank you, Anjun Zhou.
Thank you so much, Greg.
And thank you for watching The Street.